This video is for monetary policy, and it's one of the tools that the Monetary Policy Committee uses just before making a major decision. And the whole idea of it is just in terms of that communication from the central bank about the state of the economy and the likely future course of policy. And it attempts to influence the financial decisions of households, businesses, and investors by providing a guidepost for the expected path of interest rate. And what I mean by that is if the central bank were planning on making changes to the interest rate, there's obvious reasons as to why they're doing that, but they don't want it to be too much of a shock to the market and cause even greater consequences than was intended, and therefore they communicate to the market just to give them a little bit of guidance so then individuals and firms can plan for it. So if the central bank was going to increase interest rates because there was inflationary pressure, obviously the whole reason they're doing that is for contractionary monetary policy. So they do want to contract the economy, and they do want to reduce consumption and reduce investment, perhaps, more so consumption. But they don't want to reduce it by too much, and they don't want that panic to set in, really hurting confidence. So forward guidance brings a more of a stable approach to monetary policy decisions without causing, for example, negative multiplier effects. Now, they can do it in different ways, and this is from the European Central Bank, and they've got three main ways that they do it, and I suppose they differ in strength. So some of the stronger worded forward guidance approaches would be a calendar-based forward guidance, and that's got explicit reference to a calendar date, and that's much more time specific, and therefore is providing, I suppose, clearer information to the market as to when the interest rate is going to change and why. And therefore people can start to prepare for those changes. So one example being they expect interest rates to remain at present levels at least through the first half of 2020. So therefore the market don't need to react in that first half of 2020 because they're aware that they're going to remain the same. And then after the first half of 2020, they might bring in another calendar-based forward guidance, or they might bring in some of the other approaches. So some of the other approaches, you've got your open-ended forward guidance. Now that's more of a weaker worded forward guidance, and the reason for that is because sometimes it can be quite vague. So you can see that the example within this is the European Central Bank statement between July 2013 and January 2016, that they expect the interest rate to remain at present or lower levels for an extended period of time. Well, we don't know what the extended period of time is. We know it's probably between 2013, 2016. Will it be after that? There's not much information, but at the same time, at least the market know that they don't have to respond dramatically, and they've got time to start to plan for these changes in the interest rate. Now, the database forward guidance, that's more based on a policy path, and it's based on economic outcomes. So, for example, they will keep interest rates at their present level for as long as necessary to ensure the continued sustained convergence of inflation to the level that would be low but close to 2% over the medium term. Now, sometimes these messages might need a little bit more transparency. So, for example, this one, what happens if inflation all of a sudden exceeded 2%? Because of that, this medium strength forward guidance, it might cause all of a sudden the market to think, oh, well, we're going to increase interest rates then. And then they may respond, and it might cause a little bit more uncertainty within the market. So sometimes the forward guidance, it doesn't completely avoid uncertainty. Sometimes it doesn't completely mean stability, and actually it can sometimes cause people to respond. But you have to remember, if they were just to suddenly change interest rates without any notice, then that can cause greater consequences. And therefore, regardless of the forward guidance that they provide, it should provide greater stability, greater certainty, and make sure that response isn't over the top. So when we consider these two graphs, we've got the different strengths of forward guidance from weak to strong. And as you'd expect, when we're looking at your strong over here, you can see that the responsiveness is low and the uncertainty is low. So what that means is that the market already knew what was going to happen because they'd had such a long time to prepare for it and they had so much guidance. And also the responsiveness, they should have already responded. And therefore, at that point when the rates do change, not much in terms of change in behaviour will be necessary. When it's weaker, again, there is a little bit of uncertainty because people might start to think, okay, what will happen then in the future? But the response will be still quite low because they know they've got time for it. And because of the vague nature of the message, and because with the example in the previous forward guidance, it was 2013 to 2016. So they know that they've got all that time period to start responding. Now, in terms of the medium forward guidance, this is what I was mentioning before in terms of there might be a little bit more uncertainty because, again, they don't know if they start to speculate, okay, that must mean because of the message that was set, we should respond. And maybe that might impact the confidence of the economy a little bit more. But again, as I said previously, it'll still be lower than if the central bank didn't do anything at all in terms of messages and communication and forward guidance. Now, this diagram was published by the European Central Bank just to give a bit of a guide about forward guidance. So these are some examples. So the central bank makes a statement about its future monetary policy intentions, for example, keeping interest rates low. Because they've told the market that they're going to keep interest rates low, it provides a little bit more confidence of commercial banks and more stability, and it actually guides their decisions as well, because now commercial banks know that they can borrow for the foreseeable future at a lower rate of interest, so they can also offer long-term loans at a lower interest rate as well. That can then be passed on to the consumer market, and businesses and customers know that they'll be able to get cheaper loans. So then it starts to kind of prepare them to start planning for borrowing in the future. If it was the other one and the European Central Bank provided forward guidance that they were going to increase interest rates, then it would be the opposite effect. Commercial banks will start to now plan regarding their rates because they know it'll be more expensive to borrow from the central bank. So therefore, they'll start to put up their interest rates, and then again, businesses will see that, and they'll start to reduce the level of borrowing that they're carrying out. Or if they know that the type of borrowing that they're going to carry out has got variable rates, so when it comes to the point that the central bank do increase their interest rates, their variable rates are going to instantly change. That might put them off from actually borrowing. So therefore, reduce investment and reduce consumption, which is obviously what the central bank's trying to achieve by this contractionary approach. Now, I'm going to show you a quick video, a quick interview with Carney just regarding the Bank of England, and he speaks about how the Bank of England uses forward guidance and the benefits of such a system.
Just one thing on trust. I'm back on the subject of the unreliable boyfriend. You've put forward, you've tried to communicate to the British people about possible interest rate rises. You tried the idea of giving forward guidance, all these things. And yet, we're still here, still sort of flirting with the idea of interest rates. Do you think that there was no alternative looking back, or do you have any regrets about forward guidance?
No, look, I think the forward guidance initially was very much about early stages of the recovery and what are the minimum conditions required before we'd even begin to think of raising interest rates. And it's interesting, if you looked at the historic reaction function of the Bank of England, given the strength of the initial recovery, 2013 into 2014, the strength of the purchasing managers indices and the growth, historically the Bank of England would have raised rates 3 times during that period. Now, it wasn't, you can tell, revealed in terms of inflation outcomes, that wouldn't have been the right thing. But it was partly binding the hands of the committee to say, let's see what the traction is in this recovery. Let's see what the underlying inflation dynamics were. So that was a sensible thing to do, and I think it actually did give people confidence to continue to invest. Subsequent to that, we have given guidance about the likely path of interest rates, limited and gradual. It is so, we've repeated it so many times, it's so boring, it gets repeated back. It's just part of the furniture now. But that's a good thing, because that was a call we made in December of 2013.
But do you think that's a
communication?
So
2 years ago we made that call. And now it's accepted as that's the likely path. And of course it has been consistent. recently, the challenge we've been facing is what's the right timing of starting that process of limited gradual rate increases. And this economy has been making some progress. In the judgment of the committee, including myself, it hasn't made yet enough progress to start that process. At some point, that will be there. Would I rather have the majority of the British people thinking that rates are likely to go up in the next year, which is the case today? Yes, I would, because that is reasonably prudent behavior given the progress this economy is making, given the likely path of rates. Do I also want them, and particularly businesses, to think, but when rates go up, it's not going to be the old rate cycle, very sharp increases, very rapid? Yes, I'd like them to think that as well, because they can plan accordingly. At some point, rates are going to move. It's not today, unfortunately, so this isn't going to top your news. But
always trying.
Yeah, it's always trying.